So if you're buying a house, you're probably curious, there's two types of insurance on your home. There's a lot of coverages, but there's two actual pieces when you go to the closing table to determine what you're paying in your house payment. A lot of people do what's called an escrow account, where they mix the insurance and the mortgages together, which is very common. I would say 8 to 9 out of 10 people do that, myself included. What happens is you have loans and values and all of that stuff in the background. We're going to talk about the types of insurance that you are paying for when you're purchasing a house. There's two types of insurance. You've got the homeowner's insurance, which is just essentially HO3, HO5, HO6, depending on what you're purchasing. Those are the names or the levels of insurance. And HO3 is your typical house insurance. It has a few exclusions, and it's a non-named peril. So if peril's not named in it, it's just not covered. You've got your HO5, which is more of your high-end homes where they don't want restrictions. Now you've got less restrictions on things that could happen and claims that could happen. You've got your HO6s, which are condos. So if you're getting a condo, that's part of it. If you're purchasing any of those, even if you're purchasing a dwelling in any which way, you need home insurance. If you're purchasing a home brand new or used, it doesn't really matter, just purchasing a home. If you're getting a loan, so there's two ways that you can do both ways. If you're getting a loan for a house, then you need both of those insurances we're going to talk about. If you're not getting a loan for the house, it's up to you. It's your house. It's not like car insurance, because the liability risk isn't moving around the road. The government says that you don't have to carry home insurance. In which case you probably should, just to be safe, or at least carry some insurance. That way you're not in a financial burden where you can't get out of. In the scenario we're talking about, I'll link a video after this that'll go over the specific details, but you've got your coverage A, B, C, D, E, and F, which is essentially the building. You're covering your house, you're covering your contents, which is your shoes, your couch, your TV, all of the stuff you own. You're covering your medical payments for somebody if they visit your house and get injured, if they trip down your steps, they trip over your brand new Nikes that were laying on the floor, whatever the case is. You've got that. You've got your liability portion, which is if somebody were to sue you, how much are they going to back you up with? And then you've got your deductible. There's a lot of stuff in the home policy. When you go to close, you have to have insurance on the home if you're getting a loan. That's going to be just mixed into that escrow account if that's the way that you're going. Typical cost on a homeowner's policy is about $1,200 to $1,300 per year. That's across the board. Obviously, if you have a nicer home, if you get into the $400,000, $500,000, $800,000 houses on up, crown molding, giant glass windows, bathtubs in every room, all of that, like you're going a little bit higher feature set house, then those are going to clearly be almost close to the $2,000, $3,000, and they can get higher depending on the cost of materials. That's your expected home cost. There's another part called PMI, that's private mortgage insurance. When you're going to the table and you're not giving 20% down, which is a fairly common case, you're going to be required to carry PMI. It's not the only way that that kicks in, and we'll talk about the other way that kicks in, or you can avoid it in just a moment, but that's protection for the loan company. It has nothing to do with you. It means that if you can't make your payments, the loan company has insurance against you that pays the loan back or pays parts of that loan. It's required because it's a risk that they're taking. The cost of that on average is similar to the home insurance. You're looking from anywhere between $30 to $70 per $100,000 that you borrow. So on an average home, let's say it's a $300,000 house, you're on the low end looking at $900, and on the high end, you're getting up there pretty steep. I would expect it to be close to about $100 a month, right around that range if you're having a $300,000 house. There's the two pieces that trigger it, but there's three parts to that actual cost. So what they're looking at is your loan amount in total, your credit score as far as the risk of repayment and going bankrupt or whatever the case is, and then LTV, that's loan to value. If your house is less than 80%, it's about 78 to 80% of a loan to the value of the house, then they don't typically require that. That's why when you're putting 20% down, that's lowering that loan to value amount to where you don't have to pay the PMI, the private mortgage insurance. For those of you that are refinancing your home and you're trying to get a better rate on your cost or getting some money taken out, whatever the case is, just make sure that's a thing to think about. You want to keep that loan to value below that 80% because you want to make sure that you're not paying an additional $100 per month until that loan to value changes. Because now you've got to restructure it and refigure it out once that actually occurs. Let's use the same scenario, a $300,000 house. 80% of that is $240,000. So if you're going to get a loan for more than $240, you may want to make sure that you're at that level or lower. Let's play the scenario out. Let's say you own a home and you have $150,000 left on the loan, but the house is worth $300,000. It would make sense financially to get a loan for only 20% lower than what the value of the home is. So in this case, $300,000 times 20% is $60,000. So you only want to do the loan to value on that $240,000. You're going to get that additional $90,000 to put back in your bank for updates and whatever you want to use the money for. Now you don't have to pay that additional $100 to $150 or more for that insurance to pay back, because that quickly dwindles what you're taking out. It almost hurts you to have more than that loan. In the same scenario, if you had to take out more, let's just say you needed the full $300,000, well, now you've got to plan on your cost of the loan depending on the APR and the percentage that you're getting the house for. You've got the house payment. Hopefully that went down. But now you've got to mix in the private mortgage insurance. If you didn't have that before, your house payment will probably be the same, might even go up. Something to consider when you're talking about the two different types of insurance. You really need them both only if you have a loan that's lower than the 20% that's required. Otherwise, the home insurance is just going to protect you in general. If something happens, lightning strikes the house catches fire, that itself is your standard home insurance. PMI, private mortgage insurance, is protecting the company that's loaning you the money. If you want to learn more about actual home insurance, we've got an entire series on home insurance. I'll link the Insurance 101 where it's a full-length video to go over that. Otherwise, if you want to just get bite-sized pieces, what is dwelling A, B, C, D, E, and F, go ahead and check out the playlist there. Otherwise, I'm Mark with Think Insurance. I'll see you in the next one.